Welcome to our new IFRS Assurance Fund series. It's an initiative of OJ and Special Limited. It is dedicated to providing complementary and supplementary education on international financial reporting standards IFRS through a multiple choice question and answer approach. It is intended to make learning and intellectual assurance fun. In this session, we shall be considering cumulative set 210 questions to which the answers have been provided on IAS 27. This is standard on separate financial statements. Viewers and subscribers have 30 seconds to select or choose their answer to each question. The answers to the cumulative 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 11. One of these is not associated with separate financial statements. A. Presented alongside consolidated financial statements. B. Contains investment in a subsidiary. C. Contains joint venture's interest in a joint venture. D. Does not contain investment in an associate. E. Some investments can be measured at more than 2 bases. And counts. Ten seconds gone. $20 seconds gone. Time up. Question number 12. Individual financial statements are A. The same as consolidated financial statements. B. The same as separate financial statements. C. The same as separate and consolidated financial statements. D. Those without investment in a subsidiary, associate, or joint venture's interest in a joint venture. E. Those which IAS 28 applies. Can count. Ten seconds gone. $20 seconds gone. Time up. Question number 13. An investment entity may present A. Individual financial statements as its only financial statements. B. Separate financial statements as its only financial statements. C. Individual and separate financial statements. D. Individual and consolidated financial statements. E. Neither separate financial statements nor consolidated financial statements. And counts. Ten seconds gone. $20 seconds gone. Time up. Question number 14. Which of the following holds? A. The equity method and the cost method give the same investment carrying amount. B. Dividend receivable is recognized in investment accounts under both the equity method and the cost method. C. Investment accounted for at fair value is more than that which is equity method accounted. D. Dividend receivable reduces the investment carrying amount in the equity method. E. Dividend receivable increases the investment carrying amount. Some counts. $10 seconds gone. $20 seconds gone. Time up. Question number 15. One of these is least likely to be used together with IAS 27. A. IFRS 10. B. IFRS 12. C. IFRS 14. D. IAS 24. E. IAS 28. Some counts. $10 seconds gone. 20 seconds gone. Time up. Question number 16. Where an entity measures its investment in associates at fair value through profit or loss, such investments in the separate financial statements are measured at A, fair value, B, equity method, C, cost, D, net realizable value, E, any of A, B, and C. Time counts. Time seconds gone. 20 seconds gone. Time up. Question number 17. Where dividend received from an associate is not recognized in profit or loss. A, investment is measured at cost. B, investment is measured using the equity method. C, investment is measured at fair value. D, it will be an error of omission. E, investment is classified as held for sale. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 18. Where a parent becomes an investment entity, it accounts for its investment in a subsidiary, A, at cost, B, at fair value, C, using the equity method, D, at its net asset, E, all of the above. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 19. Where an entity ceases to be an investment entity, which of the measurement bases would not have been used before this date? A, cost, B, fair value, C, equity method, D, A and B, E, A and C. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 20. How many measurement bases are there for the measurement of investment in a subsidiary in separate financial statements? A, 1, B, 2, C, 3, D, 4, E, 5. Time counts. Ten seconds gone. Twenty seconds gone. Time up. We proceed to review the answers. Question number 11. The answer to question number 11 is D, does not contain investment in an associate. Separate financial statements contain investment in either subsidiary or associate or has joint venture's interest in a joint venture. They could also be presented together with consolidated financial statements. D is the answer to question number 11. Question number 12. The answer to question number 12 is D. Those without investment in a subsidiary or an associate or joint venture's interest in a joint venture. Individual financial statements are financial statements that are neither separate financial statements nor consolidated financial statements. They are the financial statements of an entity that does not have a subsidiary, associate, or joint venture's interest in a joint venture. D is the answer to question number 12. Question number 13. The answer to question number 13 is B, separate financial statements as its only financial statements. An investment entity that is required throughout the current period and all comparative periods presented to apply the exception to consolidation for all the subsidiaries in accordance with IFRS 10 presents separate financial statements as its only financial statements. B is the answer to question number 13. Question number 14. The answer to question number 14 is D. Dividend receivable reduces the investment carrying amounts using the equity method. Only option D holds. All other options are incorrect. Under the cost method and the fair value method of accounting for investment, dividend received or receivable is not recognized in the investment account, and investment carrying amount could be more or less under any of the methods. IAS 27 provides that dividend receivable reduces the carrying amount of investment when the equity method is used. D is the answer to question number 14. Question number 15. The answer to question number 15 is C, IFRS 14. IFRS 14 regulatory deferral accounts is a special purpose standard used by entities with deferral account balances in their previous accounting framework in transiting to IFRS. It is the least likely to be used together with IAS 27, unlike other standards in the options, which have a thing or more about investments in other entities or related entities, for which there are connected reporting implications. C is the answer to question number 15. Question number 16. The answer to question number 16 is A, fair value. Where an entity elects to measure its investment in associates or joint ventures at fair value to profit or loss, the investments are also accounted for at fair value in the separate financial statements. A is the answer to question number 16. Question number 17. The answer to question number 17 is B. Investment is measured using the equity method. When an entity elects to use the equity method, dividend receivable or received is treated as a reduction from the current amount of the investment. Dividend receivable or received is not passed through profit or loss when the equity method is elected for use. B is the answer to question number 17. Question number 18. The answer to question number 18 is B, at fair value. When an entity becomes an investment entity, it accounts for its investment in a subsidiary at fair value to profit or loss in line with IFRS 9. It no longer accounts for the investment at cost or using the equity method. B is the answer to question number 18. Question number 19. The answer to question number 19 is E, A, and C. For an investment entity with a subsidiary, the investment in the subsidiary is measured at fair value through profit or loss in line with IFRS 9 in investment entity's separate financial statements, which are its only financial statements. This exception to consolidation is provided or allowed under IFRS 10 consolidated financial statements. Where such entity ceases to be an investment entity, its investment in the subsidiary is from there on accounted for at cost, fair value in line with IFRS 9 or at equity method. Therefore, the measurement basis for its investment, which would not have been used when it was an investment entity, are measurement at cost and measurement using the equity method. E is the answer to question number 19. Question number 20. The answer to question number 20 is C, 3. The measurement bases are 3 for the measurement of investment in subsidiary, associate, and joint venture reported in separate financial statements. They are measurement at cost, measurement at fair value to profit or loss in line with IFRS 9, and measurement using the equity method. C is the answer to question number 20. That is all for this set 2. Thank you for joining us for this set 2 of IAS 27 separate financial statements. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all of those subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +2349 030 770109. All rights to this production and others in the service are reserved for OJ Inspection Limited. Thank you once again and bye for now.